Infinity Natural Resources just beat their Q2 2026 consensus.
Yeah, they really did. Adjusted EPS came in at 88 cents. That is a solid 14% beat over the 77-cent estimate, and revenue hit $171 million for the quarter.
Right, and management actually doubled down here. They reaffirmed their full-year 2026 guidance, so they are still projecting net production of 345 to 375 million cubic feet equivalent per day.
Which is massive.
It is. And development capex is holding steady at 450 to 500 million. But, here is the kicker for those of you tuning in. Despite beating the street, the stock actually dropped 1.86% right after the print, down to $13.69.
Yeah, it's one of those classic Wall Street head scratchers, right? Like, a company posts a beat, but the market punishes them anyway.
Exactly.
So to figure out why investors are spooked, we really need to look under the hood at the operational numbers. Total production surged 75% year over year, hitting 348.5 MMcf per day.
Which, just as a quick reminder, MMcf is just how the industry lumps natural gas and oil output together.
Right, for total volume.
Exactly. But hitting over 348 million is a huge jump. What actually drove that spike?
Well, oil. Oil was the absolute star of this report. Their oil production exploded by 102%, reaching 12.4 thousand barrels per day.
Oh, wow. 102%.
Yeah, and that volume shift toward oil is exactly what pushed them to record margins. We are looking at their highest adjusted EBITDAX ever, which was $114.7 million.
That's seriously impressive.
It is. It shakes out to a $3.62 margin per McFay, which is roughly double the average for their Appalachian peers.
Double. Okay, so they're pulling oil out twice as fast and making double the margin of their rivals. But, you look through the details of their own midstream infrastructure, there is a stat that might make you pause.
Ah, yeah, the gathering capacity.
Right, they have 1 billion cubic feet per day of capacity, but right now it is only 35% utilized. It is essentially like owning a massive 10-lane highway, but you're only driving cars on 3 of those lanes.
That's a great way to put it.
And maintaining those 7 empty lanes costs money. So I have to ask, does the lack of third-party revenue mean they're just sitting on dead capital? Or is this actually a brilliant setup for scaling?
Well, I would say stick with that highway analogy because it really explains their whole strategy. Yes, carrying that unused capacity has some holding costs today, but the asphalt is already laid.
Right, they don't have to build it again.
Exactly. Since they already own those empty lanes, expanding their own production next year won't cost them a dime in new infrastructure. They can just fill those lanes as they grow without the usual capital bottlenecks.
Which really makes sense when you look at the operational updates they just announced. They are actively tweaking how they finish these wells.
Yeah, they rolled out a revised completion design in Guernsey County.
Okay.
By optimizing things like frac sand volumes and drilling times, they are actually saving $50 on every single foot they drill.
Wow, $50 a foot. That compounds incredibly fast.
Oh, absolutely, across a whole development program. Management also announced a C-suite shuffle, bringing in Carrie Bates as the new CFO to navigate this exact scaling phase.
Wait, hold on, though. I am looking at the balance sheet right now, and something is really off.
Oh, the net income paradox.
Yes. Net income surged to $108 million. But if you look at their diluted earnings per share, it actually dropped 25% year over year. It went from $1.18 down to 88 cents. How does a company make significantly more money but earn less per share?
Yeah, that right there is the missing puzzle piece. It's probably what caused the stock to drop. It is a textbook case of structural dilution.
Right.
That EPS drop is directly driven by a 138% increase in outstanding Class A shares.
Oh, right. The Antero deal.
Spot on. Infinity bought a massive asset, the Antero acquisition for $683.9 million.
Which is not cheap.
No, not at all. And to fund that, they had to issue a mountain of equity. So the overall pie got bigger, but it is now sliced into way more pieces. On top of that, net debt has swelled to $524.1 million. They essentially took a short-term hit on their share structure to secure a massive long-term gain in production capacity.
Right. Plus, management specifically flagged upcoming cost headwinds for the second half of the year, right? Specifically on diesel, fuel, and steel. So you can see why investors are suddenly a little cautious.
Exactly. Which leaves you with a really fascinating dynamic to consider. Infinity Natural Resources clearly has the scale, the double margins, and, that 10-lane infrastructure highway already built.
Yeah.
But with rising debt service and 78% of their 2026 production already hedged at locked-in prices, you really have to ask yourself, Are they building an unstoppable profit engine, or are they just running on a treadmill to pay off their own aggressive expansion?
That is definitely a dynamic to keep an eye on. Make sure you follow the show for your daily earnings coverage.